Hey everyone, welcome back to the Web3 Daily Report. We have to start with one word today, fear. Honestly, when I opened up the charts and saw all that red, my heart skipped a beat. Over the last 24 hours, the entire crypto market went through a violent liquidation event. The global market cap is down nearly 2%, stabilizing around $3.6 trillion Bitcoin. Our market, Anchor, dropped to around $110,000. While its drop was relatively contained, Ethereum took a harder hit, cracking the $4,000 psychological level, with a weekly loss exceeding 13%. This just confirms that, during moments of panic, altcoins are always the most fragile. The data shows the fear and greed index has plunged to 28, deep in the fear zone, the lowest level since April. A lot of retail investors are panicking, but did you catch the crucial number? More than $1.6 billion in leveraged long positions were liquidated in the last day. This cleansing isn't a fundamental collapse. It's a necessary flush of accumulated froth and high leverage. Many institutional analysts are calling this a healthy reset for the bull cycle. So don't panic too quickly. What we need to focus on now is whether any structural opportunities are accelerating behind this major correction. Alright, setting aside the short-term panic from the correction, let's talk about the heavy-hitting topic that truly shapes the long-term outlook. Over the last 24 hours, the entire internet, especially X and all the major financial news outlets, has been buzzing about one thing. Stablecoin giant Tether is pursuing an epic funding round, with the plan being to sell roughly 3% of its equity to raise between $15 billion and $20 billion. If successful, this funding could value Tether at a staggering $500 billion. What does $500 billion even mean? It puts them in the same league as the current AI sensation, OpenAI. This is no joke, and it makes you pause. How can a stablecoin issuer be worth this much? Even more shocking news broke that top-tier global VC firms, including SoftBank Group and Ark Investment Management, are reportedly lining up to participate. Why are these traditional blue-chip firms suddenly so eager for a piece of Tether? Asterisk, asterisk. It signals a major leap in the strategic status of stablecoins. Asterisk, asterisk. They are no longer viewed merely as tools for crypto trading. Instead, these giants see them as asterisk strategic global financial infrastructure with monopolistic advantages. Asterisk. What is Tether using to justify this sky-high valuation? First, its jaw-dropping profitability. Tether reported a net income of $4.9 billion in the second quarter of 2025, a massive 277% increase from the year prior. Where does this money come from? Primarily from its enormous reserve of US Treasury bills. In the high interest rate environment, Tether's Treasury investments have generated massive returns. Essentially, they are profiting off the Federal Reserve's rate hikes. Second, the strategic business shift. Even with high profits now, Tether's core earnings are heavily reliant on the Fed's interest rate policy. If rates drop in the future, profits could shrink. That's why CEO Palo Ardoino confirmed that they are seeking this funding to expand their business into areas like asterisk, energy, commodities, and media, asterisk. Its $20 billion fund is less about a traditional equity dilution and more of a war chest to support Tether's infrastructure expansion and strategic hedging. The goal is clear: to ensure the company has long-term, sustainable revenues, regardless of the macroeconomic cycle, by investing in tangible assets. In short, when firms like SoftBank and Ark are willing to fight for Tether's equity at a $500 billion valuation, it transmits a very clear message. Asterisk, the stablecoin is no longer just an application layer in Web3. It has been upgraded to a core infrastructure asset coveted by traditional finance. Asterisk, this is a true turning point. Now that we've covered the grand narrative of capital and valuation, let's shift our focus to the regulatory front. Today's first major headline directly addresses the burning question: will Washington finally give Wall Street the green light for massive institutional entry? I saw this news. My first reaction was, the US regulators are finally stepping up and getting serious. The US Securities and Exchange Commission, the SEC, and the Commodity Futures Trading Commission, the CFTC, two monumental financial watchdogs, issued a landmark joint statement on September 2nd. The core message is simple but profoundly significant. It clarifies that registered trading platforms like national securities exchanges or designated contract markets asterisk are not prohibited from listing and facilitating the trading of spot crypto assets. You might ask, why is this a big deal? The problem is that the long-standing regulatory gray area is what kept many Wall Street institutions on the sidelines. They were unsure if facilitating spot crypto trading, especially those involving leverage and margin, would violate federal law. This uncertainty has been the single biggest institutional hurdle preventing capital inflow into the crypto market. Now, this joint statement acts as a green light. It explicitly tells giants like Nasdaq, CBOE, and CME Group, you have regulatory clarity to proceed. This represents a major strategic pivot in the US regulatory approach, shifting from an enforcement-first posture to collaborative guidance. Why is the timing crucial? Because over 90 applications for spot crypto ETFs are currently pending SEC approval. We all know that regulatory acceptance of the spot market is the prerequisite for any spot ETF approval. With regulated platforms now explicitly allowed to handle spot crypto, the path for ETFs tied to Bitcoin, Ethereum, and potentially other altcoins has become clearer and smoother. In essence, both the SEC chair and the acting CFTC chair emphasized that the era of regulatory hesitation is over. This coordinated stance is not just aimed at fostering innovation and protecting investors, it's about positioning the United States as the global leader in digital finance. The confidence boost this statement provides to the market is immense. It resolves the trust deficit for institutional entry, providing both legal and institutional guarantees for trillions in capital to flow into the crypto space. If things proceed smoothly, we can realistically expect the first fully compliant spot crypto products to hit the market before the end of the year. We just discussed the institutional guarantee. Next, we need to look at Ethereum, the very foundation of the ecosystem. What are the big technical moves happening there? This news directly impacts Ethereum's long-term value proposition and the cost structure of all Layer 2 seconds. Ethereum co-founder Vitalik Buterin recently highlighted a critical technical point. A core feature known as ******** peer set for deployment in the ****** upgrade ***** this December is the real key to resolving the Layer 2 scaling bottlenecks. As you know, Ethereum's scaling strategy is roll-up centric. The transaction costs for all L2S, like Base and Arbitrum, are mainly constrained by the **** data availability. **** limits enforced when they publish transaction data back to Layer 1. The Dankun upgrade last March introduced the blobs, which drastically cut L2 costs. However, with the explosive growth in usage, especially on L2S like Coinbase's Base, the data capacity bottleneck is starting to reappear. The brilliance of PeerDAS lies in its unprecedented design philosophy. It enables a live blockchain that *** does not require any single full node to download all data ***. In traditional blockchains, every full node must download and validate everything, which fundamentally limits L1 throughput. PeerDAS introduces a method of *** statistical sampling for data verification. Nodes only download small chunks of data. Using statistics to guarantee the full dataset is available across the network. By distributing data storage and validation tasks across numerous peer nodes, it *** massively increases L1's data availability capacity. To put it simply, the Fusaka upgrade will effectively double the current blob capacity. This structural improvement is the core step needed to ensure L2S can handle the massive throughput required by the next billion users. Vitalik himself stated that PeerDAS is the key to L2 scaling, and ultimately, *** the key to L1 scaling, ***. While Vitalik maintained his characteristic caution, noting that core developers are being super cautious in testing this new technology, we see a clear roadmap. Following Fusaka, the Ethereum team plans 2 more blob parameter, opting hard forks to gradually increase the blob maximum count to 21. This phased, deliberate deployment shows the core team's ambition and commitment to long-term network scalability without compromising security. This technological roadmap provides concrete support and confidence for the long-term prosperity of the entire Ethereum ecosystem. Alright, continuing our focus on traditional finance. If BlackRock and Fidelity were the early movers on Wall Street, the Vanguard Group has long stood as the staunchest anti-crypto fortress. But this fortress is starting to shift, and that's our third major signal today. They are known for their extremely conservative, low-cost index fund strategy, and Vanguard previously refused to offer any crypto ETFs on its platform, arguing that these volatile products didn't align with its long-term steady investment philosophy. But today we're seeing a significant strategic reversal. Vanguard is exploring offering its customers access to crypto exchange-traded funds. This news signals that crypto ETFs have officially completed their transition from fringe speculative product to mainstream financial standard asset class. Think about it. When a behemoth like Vanguard, which has fiduciary duty and conservative investing hard-coded into its DNA, is forced to consider providing crypto access, what does that tell you? It tells you that the market and customer demand are now an irreversible force. Competitive pressure is the primary driver of Vanguard's shift, witnessing the success of rivals like BlackRock, who have attracted billions in inflows with their crypto ETFs. Vanguard is facing a massive risk of market share erosion, especially as demand for crypto access accelerates among its younger customer base and institutional wealth divisions. Vanguard's change in stance is a signal of long-term stability for the entire crypto market. Why? Because Vanguard's client base is typically massive, conservative, and long-term focused. Once they fully open up trading channels, it is expected to introduce a new wave of more patient and long-term institutional capital. The entry of this conservative institutional capital will help stabilize the crypto market's sharp short-term volatility, further establishing crypto ETFs as a staple in mainstream retirement accounts and institutional asset allocations. Crucially, it is worth noting that Vanguard is currently exploring providing access to ETFs. Not immediately issuing its own. This reflects their ongoing caution, as they try to meet customer needs while adhering to their conservative investment mandate. They are searching for the balance point, a way to accommodate structural market changes without compromising their core value proposition. Alright, let's move on to another financial innovation. We just talked about ETF channels opening, and the news item number 4 is incredibly crucial because it marks a significant leap in the design of crypto financial instruments. The asset management firm Rex Osprey just announced the launch of the first Ethereum staking ETF ***. Why is this product such a big deal? It shifts the paradigm of crypto financial products from simply ***, providing exposure to asset price, ***, designing financial tools that generate native yield, ***. The product's architecture is brilliant. It essentially holds Ethereum and stakes it on behalf of investors within Ethereum's proof-of-stake POS network. The result is that the native yield generated by the Ethereum protocol layer those *** staking rewards. *** are now packaged into a traditional compliant ETF structure. This yield is then distributed back to investors through dividends or capital appreciation. This product caters to the strong demand from both institutional investors and retail clients for stable cash flow. In a globally low-rate environment, traditional fixed income yields are generally meager, making the annualized return offered by Ethereum staking highly attractive. For institutional players, direct staking involves technical complexity, liquidity lockup risks, and complicated tax and regulatory overhead. The staking ETF neatly solves these challenges, offering an investment vehicle that is *** liquid, compliant, and provides passive yield access ***. It essentially translates the POS mechanism from an abstract Web3 concept into a digital bond that traditional finance can easily understand and allocate, meeting TradFi's desire for institutional-grade digital yield. In terms of market impact, if these ETFs gain institutional traction, they will generate a structural tailwind for Ethereum's price and network staking rate. The ETF must purchase and lock up ETH for staking, creating continuous one-way ***, institutional buying pressure, ***. Long-term, this increased demand will not only boost the security of the Ethereum network, but may also provide robust price support for ETH due to the reduction in circulating supply. Investors should, of course, assess the related risks, including centralization, smart contract vulnerabilities, and potential slashing penalties. Of course, even in a market dominated by red and widespread drops, there are always a few outliers that explode against the current. Let's look at the 5th news story. A classic case of a short-term pump. What exactly happened here? Recently, the Apex protocol token went absolutely parabolic, with its price skyrocketing *** more than 160% in a single day ***. accompanied by a surge in trading volume to $361 million. In the Web3 space, we call this a classic case of event-driven liquidity explosion. The immediate trigger for this massive surge was the completion of its XP token conversion event, which distributed 25 million Apex tokens to users. When you see this type of event, you need to be aware of two forces at play. On one side, you have the XP holders looking to quickly cash out the airdrop. On the other, you have speculators betting that the event's buzz will draw in new capital. The latter group often uses high leverage to quickly push the price up in a market that lacks sufficient liquidity or depth. However, the sustainability of such a short-term surge is usually severely challenged. From a technical analysis perspective, Apex Protocol's Relative Strength Index, the RSI, has soared to nearly 98, placing it deep in extreme overbought territory. When the RSI hits such extreme levels, it's a strong warning sign that the market liquidity is highly concentrated in short-term speculative demand, signaling that a massive sell-off could happen at any moment. Analysts generally caution that this surge primarily reflects short-term event demand and leveraged trading, rather than long-term structural improvements in its fundamentals. What's the takeaway here? It highlights the importance of distinguishing between different Web3 growth models. Apex Protocol's movement is event-driven, a short-term burst closely tied to specific market activities. In contrast, growth, centered around major narratives like digital identity, privacy, or real-world assets, tends to have a much deeper, long-term potential. As investors, we must rigorously quantify the risk of these event-driven pumps and absolutely avoid mistaking transient, speculative frenzy for sustainable long-term growth. Alright, we move on to our final news story of the day. Finally, we'll conclude with a very serious topic that affects your wallet security, the security landscape in decentralized finance, or DeFi. We all know that DeFi protocols constantly face the risk of attacks. According to the latest figures, despite massive security investment by the industry, exploit losses reached $590 million in 2024 alone, with 2023 seeing over $1 billion wiped out. But the most alarming data point is this: a staggering 66% of all reported DeFi exploits occurred on protocols that had undergone professional security audits. This figure, 66% of hacks on audited protocols, reveals a massive systemic paradox.
It tells us that traditional one-time code audits, while providing a formal compliance badge, are no longer sufficient to cover all potential risks.
Audits typically focus on code logic and known security patterns, but they often fail to capture complex economic model, vulnerabilities risks associated with inter-protocol interactions, and the Lego block risks introduced by composability. The data further shows that about 16% of losses stemmed from blind spots or out-of-scope losses in audits. This includes hackers exploiting flash loans for price manipulation or leveraging vulnerabilities in external dependent contracts. This rings a huge alarm bell for all DeFi participants. The industry must shift from solely relying on one-time audits to embracing continuous security practices. For protocols. This means implementing broader defensive measures like formal verification, real-time on-chain monitoring systems, and economic model stress testing. For us, as investors, it means that when evaluating a DeFi protocol, we shouldn't just look for the audit report. We must focus more on its TVL stability, the decentralization of its governance structure, and its ability to withstand economic attacks. Furthermore, the data clearly indicates that lending platforms, and bridge protocols, are the categories suffering the heaviest losses from attacks. This makes perfect sense, as they handle the largest volumes of capital, have the most complex smart contract logic, and the highest risks from cross-chain interactions. Therefore, when allocating DeFi assets, everyone must maintain extreme vigilance and caution regarding these high-risk categories. Alright, that wraps up today's Web3 Daily Report. If you found this helpful, please remember to hit the like button and support us. Every day, we filter out the most essential and wealth-relevant core information from the Web3 world, aiming to help you make more rational and informed decisions on your Web3 investment journey. Also, I've prepared exclusive registration links for major exchanges in the comment section. These offer the highest rebate deals we've secured for our fans, hopefully saving you some costs on your investment path. Let's all stay rational, move steadily forward, and get rich slowly in the Web3 world. May all your crypto assets grow steadily. We'll see you tomorrow.